Hi, everyone. Welcome. As this fills out, we'll get started in just a minute. Welcome, everyone, to the Appcast Brief, the October 2024 edition, the October surprise edition with an election just 1 month out. I am Andrew Flowers, Chief Economist at Appcast. I'm really excited to kick off the Appcast Brief this month with my colleague, Josh Previte. Josh, you want to introduce yourself?
Awesome. Thanks, Andrew. Hi, everyone. I'm Josh Previte. I'm an Economic Data Analyst here at Appcast. I'm happy to be back on the Appcast Brief. I've been here a couple times before, but yeah, I'm excited.
Great. Awesome. And so just a reminder before we start diving into the September employment report that came up this morning, we are going to speak, Josh and I, for about 15, 20 minutes about the latest jobs report and also recruitment marketing trends. We'll briefly touch on some important topics that are timely, seasonal hiring and the upcoming presidential election, just briefly. And then at around the 15, 20-minute mark, we want to hear from you. And so please enter your questions in the Q&A section of this Teams meeting. So you'll see at the top of your Teams screen, if it looks like mine, there's a chat and then there's a Q&A button. So I'm going to just try to demo this in real time and just say, please ask your questions here. Please ask your questions here. And that way we can just have everything organized in that Q&A section. All right. Thank you, Josh. I'm excited to kick off the Appcast Brief with you. Let's get started. So I'm going to share my screen, and we will talk about the September 2024 employment report that just was released at 8:30 a.m. Eastern Time this morning. How does that look? Everyone see these slides? Great. Thanks, Josh. All right, so I'm going to talk about the September jobs report. High level takeaway, if you had one word, I would say incredible is not overdoing it. I've seen on Twitter, I've seen in media reports this morning, economists use words like awesome and incredible and wow. So there was a surprising increase in hiring last month. In September, the U.S. added 254,000 net new jobs. That's that blue column here to the far right on the chart. The lines that are the 3 and 6 month moving averages you see here, especially the 3-month moving average, ticked up to 185,000 over the last 3 months. So that's pretty solid. It's kind of an inflection point because economists have been asking, when will this slowing in the labor market itself slow? When will the weakening start to kind of level out and hit a bottom? And this morning's report was a surprise to the upside and perhaps an indication that the labor market is finding its footing. So that's the headline jobs number, 254,000. What about the unemployment rate? Well, it reversed its upward trend. It is still historically low. It was in August at 4.2%, and it was ticked down in September to 4.1%. So either way, that's, just a decimal point. It's still very low. But the concern over the last year and a half had been that this upward rise from 3.5% was an indication of an imminent wave of layoffs. Well, so far, we can take solace in the September report that the unemployment rate reversed that upward trend. Now, another good sign, again, this is why economists were using words like awesome and incredible, is that it had been a pattern this year for prior months to have downward revisions to the job growth figure. Well, actually today, for the September report, the July and August numbers were revised upward, which is a welcome reversal. And they were revised up by a total of 72,000. You see this here now with the green dots. The green dots are the kind of revised number, and the blue columns are the initial release. And so you see how the green dots were typically below the blue columns in say, April, May, June, and even earlier this year. That means that we're downward revisions. The green dots being above the blue columns in July and August means that we had a surprisingly welcome upward revision. So the job growth figures looking good, upward revisions, a strong number. By the way, 254,000, that initial number was well above expectations. Economists or forecasters had expected around 150,000. So job growth exceeded expectations. Unemployment declined. And labor force participation remains pretty high. Now, it has ticked down slightly from a recent peak of 84% down to 83.9, now 83.8. But however you look at it, this is the prime age workforce, 25 to 54-year-olds. You have to go back to the earlier parts of the century, around 2001, to see a period where labor force participation was so high. Again, that's people who have a job or who are unemployed and actively searching for work. So lots of job seekers out there. Another sign that maybe the slowing has slowed, that the labor market has found its footing, is in wage growth. So wage growth had been cooling pretty steadily here. You see there's three ways we're looking at average hourly earnings in this chart. One is very noisy. That's 1 month. That's the orange line. The other is a little bit more smooth. That's the light blue line. But the ultimate measure, let's look at the 12-month or the last year. What's the year-over-year growth rate and average hourly earnings? That dark blue line here, it's showing you around 4% year-over-year wage growth, which is pretty good. Now, the cooling trend, it seems to have started to level off and kind of find its footing. Again, another indicator here that we're maybe at a turning point. Let's dive into the industry job gains, because I think I want to kind of breeze through this, give you a sense of what industries were adding jobs, and then pass the baton to Josh. So a recurring pattern in the labor market the last 2 years has been something you may have heard me talk about: standing up versus sitting down jobs. Sitting down jobs being kind of like white collar, laptop class jobs, which have been very weak. And then the standing up jobs being your traditional blue collar, manufacturing, construction roles, but also kind of direct care providing jobs or service providing jobs. So here in the top three industries for September are three standing up industries. So leisure and hospitality, right? So waiters, waitresses, hotel workers, healthcare, number 2, and construction, number 3. So now, does this story perfectly line up across every industry? Well, no. You'll see at manufacturing actually lost some jobs here at the bottom. But those three industries, leisure and hospitality, healthcare, and construction, accounted for around 60% of all the job gains in September. To just walk you through each of these industries, I added a one-word commentary. So leisure and hospitality, what is it? It booms in September, 78,000 leading the way. There's been a real inflection point the last 3 months here. Healthcare, what's its word? Solid, 45,000. It continues to just be very steady and very solid. Construction, I would say, is steady. That's my word. 25,000 job growth, 25,000 job grown in construction in September. Professional and business services are fine. These are kind of your white collar jobs typically, and it had 17,000 jobs last month, but the 3-month moving average is basically flat in these white collar roles. Information and communication, these are kind of your typical tech jobs. I say they were okay. Just 4,000 jobs added, but on net over the last 3 months, it's actually shed jobs. And you see the big tech session that happened from late 2022 through 2023. So tech is still kind of suffering, or I would say just doing okay. Warehousing and storage, meh. That's how I would describe it. Lost 3.3 thousand jobs. And then manufacturing is the is the one that's kind of suffering at the moment. It's losing around 9,000 jobs over the last 3 months is the 3-month average. So lots more detail at the industry level in our report coming soon on recruitonomics.com this morning. I just want to summarize before I pass it to Josh here. The bigger picture here is that the labor market is nearly in perfect balance when we look at demand and supply, demand being total employment, which we learned more about today, but also unfilled job vacancies or job openings. That's around 169.5 million. And we compare that with the supply, the light blue line here. That's the labor force I mentioned earlier, which continues to grow. It's at 168.7 million. So this gap is less than a million, and the two lines are about to intersect. So that's the story of the labor market. A surprisingly awesome report in September, a labor market that's in nearly perfect balance. Okay, Josh, you want to take it away?
Awesome. Thanks, Andrew. So we've seen these labor market trends materialize in recruitment benchmarks and advertising costs. So if you want to move on to the first slide, we have cost per application, and that stayed flat in September. We're currently at a median cost per application of $15.99. Again, pretty similar to August to July levels. Our 3-month average, it's moving down a little bit. So we're on the whole, over the last 3 months, we're still seeing slightly decreasing costs, and certainly below 2023 or 2022. If we simplify this a little bit and look at September levels compared to 2023, 2022, it's much lower. Again, we're $3 lower than 2023 levels, and $10 lower than 2022. This isn't new. Like this, we've seen this this information, this message for pretty much the entirety of 2024. So it's not surprising to see this continue. One of the reasons for this, for our decreasing cost per application, is increasing apply rates. So of the job seekers who are clicking on job ads, we're seeing more apply. And that trend continued in September. So we saw a pretty steady increase there, currently at 5.84%. And our 3-month moving average is also moving up and to the right. If we switch to Easy Apply, cost per application actually decreased a bit in September, and this goes against what we had seen in previous months. So have Easy Apply CPAs peaked? Obviously, we won't know that for a few more months, but it certainly looks like that was a pretty substantial decrease compared to what we've been seeing for the majority of 2024. And the reason for this is decreasing apply rates for Easy Apply. We know Easy Apply is a little bit more volatile in terms of its trends than the long or ATS applies, but it is very much still worth noting that we've seen now consecutive months of decreasing apply rates, and September certainly contributed to this trend with another substantial decrease, but this has been going back almost 6 months now. Awesome. If we now look geographically, we can see how cost per application has trended across states. And the headline I have here is that these expensive states, they're not getting any cheaper. Most of the expensive regions around the United States, I'm looking at the mountain region, I'm looking at New England, are just getting more expensive. That is that contradicts a little bit with the Midwest, which we know was quite expensive in 2022. We're actually seeing those cost per application come down a little bit. If we look at the rest of the United States, it's pretty flat. Obviously, an exception here and there with Nevada and West Virginia. But again, I want to call out those major, the mountain region, New England, and the Midwest. Now, if we look across different industries, we overall know that cost per application was flat. But I found that there was actually a lot of similarities to the labor market trends that Andrew was sharing earlier. We know healthcare had solid gains. I think that was the word you used, Andrew. So we see, again, a solid gain in cost per application. We know that manufacturing had been a bit of a bust. We see decrease in cost per application there. Two that I want to focus on quickly, and more to come, is retail. As we enter seasonal hiring season, I'm not surprised to see that cost per application start to pick up a bit. What I want to talk a little bit more about in the upcoming slides is warehousing and logistics is decreasing. And so we can move on to the next slide, get a little more granular. We look at the specific job types, and leading the way are CDL drivers. We saw increasing CPAs for these drivers, a much different tone than when we had Lance Christensen on, our transportation and logistics strategic expert. We talked about how we'd seen a bottoming out potentially of CDL drivers, and that looks like it might have come to fruition. We've seen pretty steady increase of CPAs for those roles, but also increasing CPAs for the retail workers we just talked about, and also some of those healthcare specific positions. Again, focusing a little bit more on the bottom there, we see those warehouse associates, the stock clerks, are decreasing right now. So to go even further into this, I do want to pick out those roles that contribute to seasonal hiring. So first up here, we have cost per application, and we can look at the full time series dating back to 2022. And I've already talked recently about how we saw retail salespersons, we saw those CDL drivers, cost per application, have picked up. Well, the stock clerks, the warehouse associates just have not. But I do want to compare these trends to what we saw a year ago to 2 years ago. And for those retail workers, those warehouse workers, we saw a substantial increase in 2022 for the seasonal hiring. In 2023, there was a modest bump in cost per application, if anything. And so as we move into 2024, obviously the question is, what are we going to see? In retail, they have picked up. In warehouse, they have not so far. And part of this has to do with apply rate. When there are fewer jobs out in the market, we see that job seekers apply to a greater proportion of them. And we're certainly seeing that with the warehouse workers, we're seeing that with retail, and we're even seeing that with the CDL drivers. Now, that being said, we've seen the downtick a bit. Again, Andrew just pointed out, are we at an inflection point in the labor market? We've seen consecutive months now of decreasing apply rates. I think we can expect that if these apply rates continue to decrease for these types of roles, that we will see CPAs increase again. And then one thing I'm always comparing against is job postings. So as there's more competition out there for the same type of talent, we tend to see costs go up for that talent. And we have seen warehouse drivers and retail all increase within the last couple weeks. Of course, we've seen that materialize in CPAs for those drivers and for retail, but we haven't yet seen that for warehouse. There's been quite a few articles coming out specifically about warehouse. I've seen one from Reuters mentioned that seasonal hiring might be the slowest it's been in 6 years. And we were just talking about another one that said some of these major retailers are still hiring at the same level as they were in 2023. So Andrew, to ask you a question, do you think that maybe we just haven't given enough time for these postings to increase, and maybe if we add 4 weeks more of data, we'll see the effect in cost per application? Or do you think maybe we're really at these 2023 levels and we won't see the increase in cost per application at all?
I think I want to split off the two questions between, will retail as a hiring pattern this seasonal for 2024 have the same performance as last year? I do think it will. I think Amazon announced yesterday that they're planning to hire 250,000 seasonal workers, the same as last year. I think when we look at these retail hiring patterns, the hiring rate, the job postings rate, it's not too far off. And so I would think, given strong consumer spending patterns, the seasonal level of hiring needed is going to match last year. I split that off from the question of recruiting cost, right? So the question of recruiting cost, I think you're here showing, recruiting costs are roughly where they were, a little down a bit from last year. Will we see a rebound in recruiting cost this year? I think it's entirely possible that we really kind of see recruiting costs begin to pick up over the next few weeks in retail and in some of these kind of logistics positions, because of a lot of market dynamics happening across Indeed and other major channels for recruiters to get candidates. I think that we're starting to see the costs there really bottom out from this downturn in hiring. And so I think hiring at a macro level is going to match last year for the seasonal hiring bit, and the recruiting cost will probably firm up in the months ahead. So that was a great overview, Josh, and I want to get to questions now, but I just want to kind of give a bit of a teaser. We all know, I think we all do, that a month from now is a presidential election here in the U.S., and it's a coin flip. I'm not trying to be a pundit and talk about polls. I'm just going to pull some data from prediction markets, right? And so you see here between 55 and 49% odds on PredictIt for either Harris or Trump, respectively. And we're 1 month out. And I think it's a very close race. why am I talking politics, right? This is the Appcast brief. And um, we at Appcast do want to help recruiters make sense of the labor market and recruiting trends. And I think inevitably government policy, who's in the White House, congressional legislation impacts recruiting. And when we think through the 2025 planning that I know a lot of you TA HR leaders are doing right now, a lot of the recruiting planning for 2025 could hinge on the outcome of this election. So issues like immigration, taxes, outlooks towards inflation or union organizing, a lot of these factors could shape your recruiting strategy. So please, before we take questions, we want to encourage you to register today on October 15th. I'll be giving a webinar that's just 11 days from now about how the U.S. election could shape your 2025 recruitment strategy. So please, register today for that webinar on October 15th. We'll send a link in the chat there. So I think we're at time, and well, not time to stop, but time to stop sharing and have Josh and I take questions. So let me look in the Q&A chat. Any specific questions? Okay, I see one from Ravi. Thank you, Ravi. Great point here. What will the impact of interest rate cuts be on recruiting trends? So, Ravi, we saw just 2.5 weeks ago the Federal Reserve cut interest rates on September 18th. This is the first time in 4.5 years the Fed cut interest rates. It's a sign that its battle against inflation is starting to come into at the final stages. Year-over-year inflation is approaching that 2% target. What could it mean for recruiting? Lower interest rates mean lower small business loans. It means stronger consumer spending from, say, lower mortgage rates or lower credit card rates, lower auto loans. And so all this points towards a scenario over the next few quarters of perhaps hiring demand picking up. Now, how much will it respond? We don't know. Now, a lot depends on the election, right? There's a lot of economic uncertainty. So Ravi's question is right, because interest rates will likely make recruiting a little tougher as hiring demand is boosted because of lower financing cost. However, the supply issues of job seekers could totally be affected by, say, immigration policy, right? And so it's one factor among many, but great question. Hey, Grant asked a question. Josh, I'll let you take this. Is this LinkedIn Easy Apply or Indeed Easy Apply data?
Yeah, that's a good question. So in order to be job board agnostic, or at least try in our best effort to be, it's combined. There's actually other job boards too who use these easy apply processes. I'll throw Zip Apply there as well. So obviously these are some LinkedIn and Easy Apply, Indeed Easy Apply are some of the biggest players, but we, as an aggregator, we try to combine all of these publishers into one visual for you.
Great. I want to, I'm flattered Patrick asked this question. He says, Andrew, you're one of the economists who predicted a soft landing when many were saying we were headed into a recession. What's your crystal ball say for 2025? Patrick, you're very kind. A lot of forecasting of the economy is very humbling. I've definitely experienced that over the last 15 years. I don't pretend to have a perfect crystal ball or a mathematical model that is better than the wisdom of crowds, than, say, the aggregation of many forecasters' expectations. So here's my answer to Patrick. For 2025, a lot depends on the election. I know I'm trying to sell hard this webinar on October 15th, but we could really have totally different outcomes next year if, under a Trump administration, we have tariffs implemented, say 10% across the board tariffs on imports, or 60% on Chinese goods, and say we have very strong deportations of existing workers who are undocumented in the U.S. That could affect recruiting tremendously in 2025. So that's a Trump scenario. Under a Harris scenario, right, we have a lot of proposals to change homeowners' affordability and childcare, but also some big tax cliff implications as the Trump tax cuts from 2017 expire, Harris has said that she would change tax rates quite dramatically. So a lot depends on this election. So I'm not going to make any 2025 forecast until we know the results of the election, which probably won't be on the morning of November 6th. After the election, it'll probably take some time to given how razor close this election is, we may not know for a few days. So stay tuned in November. Once we have a better sense of what economic policy looks like, both who won the presidency, but also what does control of the Senate and House look like? I think those are big uncertainties that I want to know before I make any detailed forecast. And I think, we have a few more minutes here. So folks, please ask more questions. I think Ravi asked a question. What's your take on Indeed's move towards sponsored jobs? So we are at Appcast big partners with Indeed. Indeed is the largest job board in the U.S. I myself, full disclosure, used to be an economist on the hiring lab. I used to work for Indeed. Indeed has made changes under their healthy marketplace initiative that was rolled out earlier this year. And I think they're continuing to make changes to how employers who sponsor jobs, the costs that they bear when they want to sponsor jobs on Indeed, but also for folks for employers who rely on organic or free traffic on Indeed, they're seeing big changes there as well. So my big takeaway from Indeed's specific changes are it seems like the recruiting cost across the industry, not just Indeed, have started to bottom out and maybe even rise a bit. And that the amount of organic traffic on Indeed is definitely changing as they've announced at FutureWorks last week, or even with their recruit investor relations presentations earlier this year. Indeed's been very transparent. So I would just point everyone towards those Indeed presentations of how they're trying to monetize and change the marketplace to better align with the job seekers and the matches they provide employers. What that means ultimately is it seems like costs are kind of bottoming out and starting to rise, and organic traffic is, at least for some employers, starting to decline a bit. So that's the initial takeaways we see in our data on Indeed.
Andrew, if I could just add in a point here as well, that in the data that we showed today, we only focused on the paid data, meaning we don't include that organic traffic. So you might actually not see that materialize as much in the data that we show here on the Appcast brief. But again, if you look at your total cost, including both that paid traffic and that organic traffic, to Andrew's point, we'll almost certainly see a market shift.
Yeah, these are great questions. We got 2 more minutes. I just want to drop a reminder. Oh, Allison already did it in the chat to register for our webinar on October 15th. I'll just say with that, that Josh and I are ready to answer any questions you have. If you want to reach out directly to us, I'll drop my email in the chat. And I'll connect you with Josh or I if you have any questions. So thank you all for joining. This was a brief Appcast brief, as it should be. So we'll end a little early. Thank you all.